All right, in this lesson, we are going to look at debits and credits for examples 3 through 8. We kind of talked about examples 1 and 2 as I introduced you to debits and credits in the last lesson. So if you didn't watch that lesson, you might want to go back so that you can have that context as we move into examples 3 through 8. Specifically, these examples have to do with balance sheet transactions. So that's what we're looking at here. So let's go ahead and get started. As a reminder, here below me, you're going to see what I would call the key. It's our expanded equation, and then how do we use debits and credits associated with that key. I'm going to refer to that every time we do a journal entry. In addition, at the very top on the right-hand side of me, you're going to see steps 1 through 6. I'm not going to go over those specifically as we go through this video, but those are there for your reference as far as if you want a little bit more help in trying to solve for journal entries. We're actually going to do most of it, but we're not going to specifically talk about step 1, 2, 3, and 4. We will do that as we go through that. In addition, we've got the example right below that, and then we've got a set of 8 or really 12 boxes, but 8 empty boxes that we're going to fill in. The way that I like to think about those boxes is that's kind of how you should be thinking about the transaction as you're coming up with a journal entry. Now, as we go through this course, I'm going to start to remove those 12 boxes, assuming that you're getting better and better at journal entries, and therefore you're not going to need them. So a lot of students often go, why do we go through those 12 boxes, especially if you already know it? Well, we go through this because we want to help you understand what questions you should be asking yourself in your brain as you're solving these transactions from a journal entry standpoint. So then we've got at the very bottom, we've got our journal entry boxes to actually do our journal entries. So with that, let's go ahead and start with example number 3. Walnut Creek borrows $10,000 from a bank, which is deposited into their bank account. The bank requires Walnut Creek Inc. to sign a formal agreement for repayment of that $10,000. So what's happening here? Well, Walnut Creek Inc. is borrowing $10,000. So they are getting $10,000. Now, what are they giving up? They're giving up a promise to pay. So they're giving up a promise to pay $10,000 in the future of their own money back to the bank. So although, they're not really giving up anything initially, they are giving up that future right to that cash because they're going to have to repay it back. So it's a promise to pay. Now, in this example here, it's also a formal agreement. So it's a promise to pay and a formal agreement. In the last couple of lessons, we've talked about how we have really 2 types of promises to pay. We've got our notes payable and we've got our accounts payable. Accounts payable are those revolving type credits. Notes payables are actual formal agreements, formal notes, formal loans that typically requires a formal document signed by the 2 parties establishing terms, as well as establishing the interest rate and the payback period and all of that information on that formal agreement. So in this case, we have a formal agreement. Therefore, instead of using an accounts payable, we're actually going to use a notes payable. So that's what we're going to do here. All right, so let's take a look here at our 12 boxes. What accounts are going to be affected? So we are receiving cash, and then we are giving up a promise to pay in the form of a notes payable. So we're going to write here cash, and we are going to write notes payable. All right, so what components are each one of these items? So cash, we know, is a future benefit that can be used to yield better benefits in the future for the company. So we are going to call that an asset. So cash is always an asset. What about our notes payable? So notes payable is something that we owe. We owe that to someone else. Therefore, we said of the 6 components, that's going to be a liability. So liability there. And then are we going to increase or are we going to decrease? So cash, we're receiving cash. So because we're receiving cash, we're going to increase cash. What about our liability? What's happening with our liability? Well, our liability, we have more liability that we're going to have to pay back in the future. Therefore, that is also going to increase. So we're going to increase notes payable. All right, so remember that when we're talking about increasing and decreasing, just because one increases doesn't mean the other one has to decrease. They both can increase, they both can decrease. One can increase, the other one can decrease, and vice versa. So that's important to understand there. All right, so cash is an asset and it increases. Are we going to debit or credit? So now that we have everything that we need, we can look at our key to help us solve that component there. So cash is an asset, so it's an asset. The asset's on the left side of the equation, and we also know that cash is increasing, so it's increasing. Therefore, we're going to debit cash. What about notes payable? Well, notes payable is a liability that is also increasing. So liability increasing, notes payable, we're going to credit the account. So that's how we kind of use the key. Again, using the key can help you understand if we're going to debit or credit, especially if you're just learning how to do journal entries. All right, so now it's time to do our journal entry here. We know that journal entries, the debit goes before the credit. We know that there's 3 sets of boxes here. The first set's for the account name, the second set's for our debits, and the last set is for our credit amounts. We don't have to fill in all the boxes. And when we do our credit, we're going to indent the account name, then write the account name after that indentation space. So let's start here. The first one that we're going to deal with is our debit. So which one are we going to debit, cash or notes payable? Cash. So we're going to debit cash for $10,000. And we're going to credit, which would be the next line, give an indentation space here, notes payable for also $10,000. So we're debiting cash for $10,000 and we're crediting for $10,000. That is our journal entry at the end of the day. All right, so if you've got that under your belt, let's go ahead and go to example 4 here. Walnut Creek purchased $11,850 worth of furniture, fixture, and equipment related to their offices. They received their gear as promised from their vendor, so they have received it. Walnut Creek Inc. promises to pay within their credit terms with their vendor. So they're going to pay with credit terms, meaning that they're not paying now, but they're going to pay sometime in the near future. All right, so let's start with the account. So what accounts being affected? What are they getting? They're getting equipment. We're going to just summarize it by calling it all equipment, even though it's probably furniture, fixtures, and equipment, but equipment. So they're receiving equipment in exchange for a promise to pay, a future promise to pay. Now, is this like the last example where it's a formal note? Well, nothing here says it's a formal note, so we're not going to deal with notes payable. Instead, we're going to deal with accounts payable. So we are going to deal with equipment and accounts payable. So those are our 2 accounts. So equipment and accounts payable. Now, what component is equipment? Well, equipment is something that provides the company some type of future benefit. So if that happens, then that is an asset by definition. What about the accounts payable? Well, accounts payable is something that we owe, and because it owes, we call that a liability. So that's a liability. All right, so is equipment increasing or decreasing? Well, we're receiving equipment, so that's going to increase the amount of equipment we have. And our accounts payable is a liability. We now owe more. Because we owe more, that's also increasing. And so equipment is an asset that's increasing. If we go to our key here, it's an asset. It's increasing. We're going to debit the account. What about our accounts payable? Well, our accounts payable is a liability. It is also increasing. Therefore, we're going to credit the account. All right, now that we got everything that we need to know, it's time to do the journal entries. We're going to put the debit before our credit. So we're going to debit first equipment. And we're going to debit equipment for $11,850. And then we're going to credit the accounts payable for $11,850. So that's going to be our debit and our credit. All right. If you're good with number 4, let's go ahead and move on to number 5 here. Walnut Creek pays half of the $11,850 owed to their equipment vendor from example 4. So $11,850 divided by 2 gives us $5,925. So $5,925 is the amount that we are going to debit and credit. Now I can save a little bit of time here by just going ahead and putting $59.25 in the debit, $59.25 in the credit. Why do we know that's going to be a debit and credit just like that? Because we know that every entry is going to have at least one debit and one credit. And the debit needs to go first, the credit needs to go second. So we already know that is a fact. The question is what are the accounts and which one's going to go first versus which one's going to go second. All right, so Walnut Creek pays half of the $11,850 owed to their equipment vendor from example 4. So if we go back to example 4, we notice that they got equipment and they didn't pay for it. So now we have to pay for half of it. And you might go, why didn't they just pay for the whole thing? Well, they didn't pay for the whole thing because maybe they didn't want to. Maybe there's a cash flow problem. Maybe because they are at they're nearest to their credit limit and they want to buy more. So in order to buy more, they have to reduce it a little bit, but they still have a little bit of time before it's due. So they don't want to pay it all off because that's basically interest-free money that's going away when they can make some more money. So that's a finance thing. So there's a lot of reasons. So they're going to pay half of it. But if you notice here, we've got to do a couple things. They're going to pay with cash. So cash is going to go down. And they're also going to be released of a liability. So where's the liability? The liability is considered an accounts payable. So we have to release that. So to do that, let's talk about the account. So the account. So how are they paying for it? Well, they're paying for it with cash. So we know that cash is going to be affected. And we also know that they're going to be released of a liability. So to release a liability, we have to do opposite of what we did when we actually included their liability on their books. So we are going to hit the accounts payable account. So accounts payable. All right, so cash, is it an asset, liabilities, owner's equity, dividend, expense, or that's everything. So cash is an asset, so that's an asset. What about accounts payable? So accounts payable is a liability. All right, so cash is an asset. Is it going to increase or decrease? Well, cash, assets coming out of my pocket, so we're going to decrease the account. What about the accounts payable? Well, accounts payable is a liability. That's also going to decrease because we're releasing the amount that we owe. We're being released of the obligation to owe that amount, so that's decreasing our liability. Cash is an asset, it's decreasing. So cash is an asset, it's decreasing. Therefore, we're going to credit the account. What about the accounts payable? Well, the accounts payable is a liability. It is also decreasing. Therefore, we're going to debit the account. All right, so now that we know the analysis, the question is what comes first, what comes second? The first thing that came to us is going to be a debit. So which one of these two accounts are we going to debit? We're going to debit the accounts payable. So we're going to debit accounts payable, and we're going to credit cash. All right, so debit accounts payable, credit cash for $5,925. All right, so that's example 5. Moving on to example 6 here. Walnut Creek signs a contract with a sign designer, Joe's Intelligence, to design and install a marquee sign at the front of their venue. They have agreed on the cost being $6,540. No sign has been received yet. All right, so they signed a contract, but no sign was received. It doesn't look like cash was exchanged. So the question is this a transaction first? And the answer is no, it's not a transaction because nothing was actually exchanged. Now remember, this is an example of a promise. A promise That is not a promise to pay, basically. A promise is not a journal entry because it could be voided. It could be a contract that gets changed. It could be a contract that has a problem with it. Maybe it's not enforceable. So until it actually happens, it's not really a transaction at all. So we have no transaction, so then we don't need to do a journal entry. So it is kind of a trick question here, but we want to make sure that you know that a promise to pay is not a valid transaction, so we don't need to enter those into our books. An exchange has to happen. No exchange has happened. Just a promise has happened. All right, moving on to example 7 here. Walnut Creek receives their marquee sign, so now they receive their sign. And they pay $3,000 in cash and promises to pay the rest in 30 days. All right, so this is an example of a compound journal entry. The reason why it's a compound journal entry, it has more than 2 entries. So in this case, we have 3. You might go, what are those 3? Well, let's break this down here. What accounts are we going to use? Well, we are receiving what? What are we receiving? We're receiving a sign. So we're receiving the sign. So I'm just going to use sign as the account name. And then what are we giving up? Well, we're first going to give up cash. We know that because it says we're going to give up $3,000 in cash. So we know we're going to deal with cash, but that's not going to pay for all of it. So we're also going to give up what? We're going to give up a promise to pay. So we're going to give up an accounts payable. Now I can't fit it all here, so I'm just going to abbreviate. So accounts payable. So that's a compound entry here because we have more than 2 accounts that we're going to have to deal with. All right, so sign, cash, and accounts payable. All right, what component is sign? Well, a sign provides future benefit to the organization long term. So we're going to consider that an asset. What about cash? Well, cash we know from previous examples is an asset as well. And then accounts payable is what we owe. And if it's what we owe, then it becomes a liability. So sign's an asset, cash is an asset, accounts payable is a liability. All right, does the sign increase or decrease? Well, we're receiving more, so that's going to increase. Cash, we are paying it, so that's going to decrease. And then the liability, we owe it, so it means that we're going to owe more. Because of that, that's going to increase. So we have an increase, decrease, and increase, and that's okay. All right, so the sign is an asset. The asset is going up, so that's increasing. We're going to debit the account. What about cash? Well, cash is also an asset, but we are going to decrease it, so it's going to be a credit. And what about our accounts payable? Well, our accounts payable is a liability. That liability is increasing. We're going to credit that as well. All right, so now that we have all of these, it's time to actually book our debits and our credits. So let's start with our debit. Our debit here is going to be to the sign. Now, we really don't have a price for this, but how could we else get it? Well, we can get it by adding the cash that we paid and what we're going to owe in the future. So if we add the $3,000 to $3,540, we get $6,540. All right, now it's time for the credit. So the credit here, we can choose either cash or accounts payable. Which one do we choose? The real answer is it doesn't matter. So we're going to credit cash first for $3,000, and then we're also going to credit accounts payable for $3,540, and that's okay. Now, if you put accounts payable before cash, that's fine, as long as your debits equal your credit. So how do we know if we've done this semi-correct? Well, my debit is $6,540. My credit is $3,000 plus $3,540 gives us $6,540. So our debits equal our credits, which means we're good. So on a compound equation or a compound journal entry, we can have as many journal entries as we want or transaction lines as we want, as long as our debits and our credits equal one another. All right, moving on to our last example here, example number 8. Walnut Creek receives supplies costing $825. So very simple example here, and they did it on account, which means no cash was exchanged. They bought it on account. So what do they receive? $825 worth of supplies. What do they give up? A promise to pay. So the account will be supplies and accounts payable. So what component is supplies? Well, supplies is a future benefit because we can use them later. It's kind of like having supplies in the supply cabinet. Because they haven't been used yet, they're not technically supposed to be expense. You still have them. You could still sell them. So we consider that an asset. What about the accounts payable? Well, accounts payable is what we owe. We said what we owe is a liability. All right, supplies is an asset. Is it decreasing or increasing? Well, we're receiving supplies, which means we're also increasing supplies. What about accounts payable? We now owe, we know more, so we owe more, and that's going to increase our liabilities. All right, so supplies is an asset. The asset is increasing. We are going to debit the account. What about our accounts payable? Our accounts payable is a liability. That liability is also increasing, so we are going to credit that account. So we'll debit supplies for $825, and we'll credit accounts payable for $825. So that's what it looks like there for that journal entry where we receive supplies, but we don't pay it in cash, we pay it on accounts. So that is us look at examples 3 through 8. Here is a summary of all the transactions that we did from top to bottom, from example 1 that we did in the last lesson to example 8 that we did in this lesson. These are all the transactions. You're going to need to know them because as we go into the next lesson, we'll talk about how do we post them to what we call T accounts, and we're going to need these entries in order to be able to do that. So hope you enjoyed this walkthrough of the journal entries, and we'll see you in the next video. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below and I'll respond to you on what you got out of this video. So hope you enjoyed this video and we will see you in the next lesson.